All right, so we're going to talk about ask, bid, and spread for this video. It's a relatively quick one. These are trading basics here. So what I have pulled up is from a website called Tensor Charts, Tensor charts.com, and all it is it's a heat map. And so what a heat map does is it shows where there are resting orders, and it also shows us the order book. So the order book is this over here, and these resting orders are these lines right here, right? You see these little yellow lines and red lines. Those show where the orders are, and the color of it shows how big those orders are. So the brighter the color, like the more yellow it is, then the bigger the orders are. So there's more. In this case, above is asks, which means that there's more Bitcoin that is being offered for sale at that price. That's what an ask means. It means that someone is posting a limit order. A limit order means a resting order that states that if someone gets up to that, if the price gets up to that point, then in order for it to go any higher, it'll have to those coins will have to be bought. They're offering it. That's their offer. It's another way of saying it. Another term that's used for it is their offer, right? So they're saying if you would like to sell it, or if you'd like to buy it, you can buy it up here. And these orders resting here means that they're resting over a period of time, because we still got the x-axis here is time, right? Y-axis here is price. So someone has put, for example, right here, once price got up to here, someone started placing these orders here, and they left them there for a while, and then eventually they pulled them. Maybe that means that they thought price would go up. Maybe these are being used as a way of liquidity generation. Maybe they're being used to get people to enter shorts, to say, oh, well, the big boys are on my side and they're shorting this, or they're guarding the price here. So there's a lot of game theoretics that can go into it, but at the key of it, that's what it is. That's how you read one of these charts. And it doesn't necessarily have anything directly to do with ask, bid, and spread, but it's a good visualization of it. It's a good way of understanding it. Saying here, right here, I've got, I don't know how much this is, let's say it's 100 Bitcoin. If price gets to here, this level, I'll sell 100 Bitcoin. And you'll be able to buy 100 Bitcoin at this level, and you won't be able to go any higher until you sell it. Until you buy it, until I sell all my Bitcoins. That's what that means. Unless they pull it, like it could be partially filled. Like say, for example, price got up there and people were starting to purchase it. That would mean that the ask would be getting smaller, right? Because more people would be purchasing it, and as they're purchasing it, there's less to be sold at that price. And as there's less to be sold at that price, that means that it gets easier for price to rise. So if someone were not serious about selling their Bitcoins there, they could, for example, pull it. They could pull the order, and that's what someone did here, right? They had an order there for a while, and then they took it away for a bit. And when they took it away, the price dipped. Now I don't know if there's any much correlation to this. I don't really, there is some correlation, but it's easy to manipulate these books. It's free to set limit orders. That's something to keep in mind. It's free to set limit orders. Anybody can set an order here, and they can pull it, and there's no cost. If it doesn't get touched, then literally nothing changed for them. Their account stayed the exact same. But that's a little bit of a digression. For now, what we're going to look at is over here is the ask and the bid, right? So these are the bids. Let me erase this crap. Oops. So these are the bids down here, and these are the asks, right? And so when you look at an order book like this, what you're looking at is different levels and how much is for sale at a certain price and how much is willing to be bought at a certain price. So these people down here are the bidders. And they're saying that if Bitcoin gets down to 16,070 right here, right, then they will buy 70 Bitcoins, 70.12 Bitcoins. And so that's a lot of Bitcoins. And down here, 63, if it gets down to 16,060, they'll buy 63 Bitcoins, 70 Bitcoins again. So there's a lot there. And then up here, if you look up here at 16,210, which we're seeing right here, it's a big order there. If at 16,210, we've got 191 Bitcoins for sale. So there is somebody, or perhaps multiple parties. That's annoying. Freaking delete. There's somebody or perhaps multiple parties that want to sell their Bitcoins there. Delete that. And yeah, so for now, if price gets there, then those will have to be bought there. And if someone's serious about it and they actually want to sell it, then they'll leave it there until they're all bought. Or if they really want to sell it, sometimes you'll see these orders get dragged down along with price, which tends to have a negative price effect, because if those orders continuously get dragged down whenever there's any buying pressure, that buying pressure runs into a big wall. And when that buying pressure runs into a big wall, that means that it can't keep going up, right? Just like with buying, if there's a lot of, FOMO or whatever you want to call it, people are afraid of missing out on a big pump, they may start getting these big orders like this, and they might start walking them up. So every time price goes up, if price goes up $10, they might say, okay, I'll move it up another $10. Another $10? Okay, well, I'll move it up another $10. I really want to get filled on this. Because, you could market order, and market order means that you take the nearest ask. That's what you're doing when you market order. Your market buying is simply purchasing the nearest ask. So say you want to market buy 50 Bitcoin. You'd start off here and you get the first 1.39 at this price. Let me erase some of this crap. It's doing that crap again where it's turned into a circle. Okay. Anyways, so say you want to buy 50 Bitcoins, right? You'd get 1.39 at this price, 16,130. You get 2607 at this price, 16,140. 20.69 at this price, 16,150, and etc. You get a few at this price, right? That's if you were just a market buy. But there's some issues with market buying, and part of the issue is that your entry does slip. Like say for example, you want to market buy 50 Bitcoin, the price by the time you got done would be up here. It'd be, around 16,160, and you started at 16,120. So that means that you slipped the price $40, which means that your cost of Bitcoins went up $40 while you were buying, in the middle of you buying. So your average entry, may be something like, a $20 increase, something like that, average slippage. But it's not ideal. You don't want to buy for more than you have to. So that's why, you typically, with larger orders, you see larger players chasing price with these limits. And what they're doing when they chase price is they're jumping across the spread. So the spread, they aren't always jumping across the spread. But when it gets really aggressive, they do start jumping across the spread. They could just stay back. They could stay back, $50 like they're doing here. But anyways, the spread is the difference between the ask and the bid. So this isn't actually accurate about what the spread is right now, because this is just the resolution is low. But for this theoretical example, let's say that the spread is $10, right? So it's between 6120 and 6130, right? That means that there's a $10 difference between buying and selling at market price. And what that means is that if you market buy, you're market buying for 16,130, right? But if you market sell, you're market selling for 16,120. So there's a $10 gap. And once again, this isn't accurate. This is just resolution based on this website. But when you're on an exchange and you see this, you'll see the spread there, and it'll be usually a couple bucks, something like that. Depending if it's on a futures exchange, it's usually like 50 cents. It's usually just one tick. But anyways, so the spread is used by participants that want to get into the market faster, and they can start front running. Like say for example, we have price here, and then the bid is here and the ask is here. There's a lot of room in here. There's room in there for people to place orders if they want, so they can get in front of that person right there if they want. And so when you see the spread changing, what that means is that people are moving their orders either up or down, right? So they're moving their these are limit orders, so they're moving their limit bid here. And if say this is $5, right? Let's say that's $5 gap between here and here, right? Well, then someone could step in and say, okay, well, I want to make it a $2 gap, right? And then they're in front of these people now. Now, if someone sells, then they get to buy a slightly higher price, but they get to buy before these people. They're first in line, right? So spread involves the line, in essence, between the ask and the bid. And a lot of times there's gaps. There's almost always gaps, except for on futures exchanges. Like I said, the futures exchanges don't usually have much of a gap on spread, especially if they're liquid enough. But recently some have. But either way, on spot exchanges, which is standard, Binance, Coinbase, all those types of exchanges, Bitflyer, Bitstamp, all those exchanges, there usually is a spread. And so that spread, as that spread is manipulated, it tells you something. If the spread is continuously jumped on the ask side, that means that either someone actually is wanting to buy really aggressively, or they're trying to fake you out, right? There's always that option. Maybe they are trying to fake you out. What you can look at is whether or not they're getting filled. So if someone is aggressively pushing it up, and then as soon as they get filled, they run away, it's kind of sketchy, right? They don't seem like they're really serious about buying. They're window shoppers, right? We don't want window shoppers when we're looking at ask and bid and spread. The goal is to, if whether you're a large player or a small player, you want to go with where the market's already going. You want to use a judo of sorts when you're purchasing or selling, right? You don't want to sell at the bottom, and you don't want to buy at the top. Nobody wants to do that. But inherently, the market is a competitive endeavor, and it's a not even a zero-sum game. It's a less than zero-sum game, because the exchanges are taking fees from you. So that being said, you've got to try to intuit what's going to happen next. And As part of your trading strategy, you should always be looking at ask and bid and spread. And even if they get a little scammy, there are some spoofing bots where people will rapidly, flicker like, oh, there's a huge bid, and then nope, it's gone. And oh, there's a huge bid, and it's gone. Even if they're flickering like that, it's something to factor into your trading. It's something to be cognizant of and something to know about. So that's the basics of ask and bid and spread, and a little bit of digression, but I think we did pretty good. We didn't digress too bad.